innovate, enable. Standard Chartered and CNBC-TV18 present India on the Move, Season 6.
Hello and welcome to the 6th season of Standard Chartered and CNBC-TV18 present India on the Move. I'm your host Gautam Srinivasan, and joining me in today's conversation around reshaping strategies for wealth management in the post-pandemic economy are three leading voices from the industry. On the agenda is an in-depth look at how wealth firms are adopting a customer-centric and tech-enabled strategy to deliver results. Our speakers on the panel include Ashish Somaiya, CEO at White Oak Capital Management, Suchintan Chatterjee, partner for the financial services consulting practice at Deloitte India, and Saurabh Jain, managing director and head of wealth management at Standard Chartered Bank. Gentlemen, great to have you with us. Looking forward to understand how the world of money itself has changed post the pandemic. Saurabh, we'll start with you. We've seen the rise of mass affluent investors with new expectations. So I want to understand from you, considering how technology has enabled wealth management to become more democratized, how's the wealth management industry itself reshaping itself?
Technology has really been a very positive disruptor, and we've seen an emergence of mass affluent clients coming into the wealth management industry. The broader theme underlying has been financialization of savings, which we've seen over the last few years. But COVID or pandemic has been what I like jocularly saying is the best chief technology officer, which has actually really metamorphosed and catalyzed the growth of the wealth management industry. Where what's happened is that wealth management firms and industry has broadly used technology to get clients to be onboarded and to be able to transact, and also to do mass personalization at scale. Earlier, what you could do for ultra HNI clients, using a technology at a cheaper cost, you are able to do personalize for clients. I'll give you an example of what we've done in Standard Chartered. About a year back, we launched our mobile technology platform, and we have seen over the last 1 year the kind of features that we have launched in terms of DIY onboarding, the kind of SIP pre-packages, pause and resume of SIP, fund comparisons. We've been very positively surprised. We've had more than 10,000 clients open their investment account in the last 1 year or less than a year with us. So what we've seen across broadly the trend in the industry is that a lot of the tech capabilities are actually driving higher adoption by mass affluent clients of wealth management, of being able to invest. So that's the broad trend we've seen, and that's what we've seen, not just for us, but we've seen the industry really respond very positively.
And taking that forward, Suchintan, one of the 10 disruptors to wealth management identified by Deloitte, it spoke about the rewired investors, new standards, new expectations, and in fact they feel that they should get access to the same set of products and advice which ultra high net worth individuals do. So take us through how this reshaping the wealth management industry, and what are things looking at right now?
Now, if you look at the customer is at the starting point of the disruption, right? Sort of spoke about how the rise of DIY has been accentuated by COVID, right? We're seeing a lot of adoption of self-service, and this is sticky adoption. When we say sticky adoption, it means once you adopt a digital channel, you are very happy with it and you continue to kind of stay on with the same wealth manager, and therefore it provides opportunities to service that client at various moments of truth, right? So that's one of the first themes I would want to call out. I think the second thing that we are seeing across financial services, some of the expectations around experience are being shaped outside the industry. So I am no longer thinking this is how my wealth manager should treat us, but if anybody else in the industry, whether it's e-commerce, the shopping experience that I have, I want the same when it comes to my wealth manager, right? So that's the second theme that's playing out. The third theme, as you said, there's a huge democratization of wealth, right? In India, as we are seeing, what it means is with the expanding envelope, the preferences are different. So wealth managers need to understand what are the choices, preferences. That one size fits all approach will never work, right? Those are some of the customer-centric themes I wanted to call out.
Getting down to the brass tacks, Ashish, what's the investment mix of wealthy private clients looking like right now? Because, the pandemic, it was a black swan event. And, I want to understand how has their thinking changed around risk and uncertainty? Because the Standard Chartered Wealth Expectancy Report, it pointed out to the fact that 94% of the people surveyed, they have reset their life goals. So in this context, take us through risk and uncertainty and how it's kind of affected the entire investment mix of wealthy clients.
I was a bit surprised with how investors have negotiated the last 2 years. And 2022 is a great example. There's an entire cohort of investors who's kind of come out very strong after this whole 2020 experience. So for example, if you see after demonetization is when digitization really got the first fillip. It got accentuated with COVID, but it was basically demon when we all kind of got adapted to digitization. There's a huge cohort of investors who came because of low interest rates leads to capital market adaptation, and experiences like demon and COVID result in even digitization, right? So 2016, 17, 18, there was a big influx of investors into the capital market. So that bunch of people, when COVID came, that bunch of people thought, man, this place is not for me. But 2020 also, a new bunch of people came and they thought, what is so difficult? I mean, this is... Now the reality is it's not as tough as it appears to the guy who came in 2017. It's not as easy as it appears to the guy who came in 2020. But I think the last 4 or 5 years from that perspective has been fabulous to get people acquainted with,
because they see market cycles going, they understand that there will be low points and there will be high
That's why you're seeing 2022, the reaction is very different.
All right. Let's see what Saurabh has to say. Saurabh, we had Ashish talk about risk and uncertainty, but from a plain returns perspective, what are the expectations which are shaping up? Because when, say, equity markets cool off, the worries, what happens to the economy? So in that context, how is the returns picture shaping up for wealthy clients?
Our view has been, since the beginning of the year, that 2022 is a year of mid-cycle. Mid-cycle transition is classically defined by, withdrawal of monetary policy stimulus. That leads to volatility in markets. Ashish made a very interesting point on, low rates. Add to that, we've seen clearly that low real return is something that clients have been worried about. That has led them to a hunt for yield. If you have low real return, and the classic defensive strategy of bonds should work out, when equity markets are having volatility, bonds should have performed for you because it's a defensive product. But we've seen that correlation break down. We've not seen bonds perform the same way over the last year and a half or so in an environment, where that's not worked. So investors have then looked at taking more risk in their portfolio in the hunt for yield. So they have looked at, taking more risk through equity. They have looked at taking more risk through alternate products, and also products, which are completely alternative strategies, whether it could be REITs, it could be AIFs and so on. So that's what the broad play has been. From a market perspective, our view is that we are placed more like a 2004 or a 2011. And we have a couple of things going very well, given the strong macroeconomic fundamentals and strong earnings as well. We believe that there will be a third year in a row where we'll have, earnings growth in teens, and actually 35%, 15%, 35%. And this year, again, we expect earnings growth about 15-16%. So our view on the balance is that clearly equity markets will still continue to give superior return compared to other asset classes, but there will be volatility, and then clients will have to, because there is a global context as well that you look for.
And that's the value that wealth firms bring to the table for their investors, right? Navigating this volatility, helping your clients navigate this volatility. In fact, this scenario is perfect for you to demonstrate your value to clients, isn't it, Saurabh?
Yeah, absolutely. This is exactly the time when you have to stay invested, you have to stay diversified, and you should, because we believe that the cost of missing out is far more of not staying invested. A simple, analysis will show you that if you were out of the market for the 10 best trading days, your 20-year return of Nifty, which is 12%, would have fallen to 8%. You were out for 30 days, best 30 days, you will fall further to 3%. So you have to stay invested, you have to stay diversified, and that's where wealth management firms can come in.
Stay invested and stay diversified. That's the message coming in. On the topic of staying diversified, international diversification seems to be, catching the fancy of a lot of wealthy investors, as data from the central bank shows that there's been a lot of investing abroad at record rates. So I want to understand from you, Ashish, what's the investment mix in terms of, investing in assets abroad? What's the picture looking like there?
One clearly is digital adoption. And when I say awareness, people understand. Any investor who's observing things, reading, would understand that a lot of the digital economy is these American firms or is these truly global firms. The second thing in the last few years we've seen is that, very frequently there are spikes in oil prices, there are commodity prices, metals, etc. So anybody who's observing India's economy and India's markets, any investor, should have observed these trends. If you want to participate in the growth of the digital economy, you have to invest in the US. I mean, US is the mecca of all innovation, and everything new that seems to happen seems to emerge from there.
Any interesting themes emerging there as folks look to diversify?
Yeah, so if you see the whole digital media, everything in digital media is obviously these American firms. If you look at, say, for example, technology, then not just US, say, for example, South Korea, Taiwan. Then I was talking about commodities, etc. So Middle East, Brazil, Indonesia, some of these. So the point is that if you're an equity investor, it's natural that you'll start with a home country bias and your money will be in India. But as you become better at it, as you interact with more wealth managers, as you start getting the right advice, you will realize that an equity portfolio, according to me, has to have three components. One is our Indian equity. Second is to invest in those emerging markets which kind of complement what India doesn't have. So, whether it is high tech, whether it is commodities, whether it is metals. The third is obviously US. Because US companies are truly global. In fact, I checked some database at the S&P 500. Virtually half the earnings of S&P 500 companies are global and the other half is domestic US, right? So I think broadly these three components are very, very important when it comes to equity investing, and we are seeing more awareness and more adoption.
All right, hedging their bets to make sure that the global growth story works for them. Well, it's time for us to take a very short break, but stay tuned on the other side as the discussion continues.
Standard Chartered and CNBC-TV18 present India on the Move, Season 6.
Can someone working alone solve all the world's biggest challenges? Isn't collaboration the way we'll produce enough food for a growing population? And supply tomorrow's mega cities with clean water? Isn't working together how we'll make lighter, more sustainable packaging? And generate limitless energy? As one of the world's leading chemical companies, we believe the chemistry between people is the chemistry that matters. SABIC.
IX-Ego.
दादा IX-Ego नहीं Ixigo.
Exigo.
Exigo नहीं Ixigo.
नाम में क्या लगा है बिड़ू? सीधा बोल देने का. Ixigo ट्रैवल ऐप डाउनलोड करो, बिंदास टिकट बुक करो और निकल लो.
Who will be the CNN News 18 Indian of the Year 2022 for Startup category? Catch the grand finale of the most awaited news event, CNN News 18 Indian of the Year, on 12th October, 6 p.m. onwards, only on CNN News 18.
This Diwali, celebrate the grace and glory with Mahalaya, a collection inspired by the royal heritage of Maharashtra, Reliance Jewels.
The journey of success has many moments. Some reflect your taste, and some your class. But there is only one that shows you are a class apart. LG OLED. Celebration of your success. LG OLED, the one and only.
My dad has won a medal for bravery. He's a major in the army. He protects everyone. Karan, what does your dad do?
Rohan, your daddy.
Karan, tell us now.
He's an LIC agent.
That's great. Imagine what if something untoward happens?
So?
Well, Karan's dad provides proper guidance to protect our family's future.
We are proud of our million-plus agents who continue to protect countless lives. We welcome you to LIC. Visit your nearest LIC branch.
Standard Chartered and CNBC-TV18 present India on the Move, Season 6.
Welcome back to this very special episode of Standard Chartered and CNBC-TV18 present India on the Move Season 6. And of course, today we are discussing the topic of reshaping strategies for wealth management in the post-pandemic economy. Resuming the discussion, Ashish, let's look at alternative investments. How much has the share of, say, alternative investments, asset allocation for alternative investments in the, say, high and ultra-high net worth category grown as a hedge against uncertainty in equity and debt space, and what type of alternative assets are generating most interest?
10 years back, the mutual fund industry in India, debt and equity put together, was about 7 lakh crores. Out of that, equity was about 1.7 lakh crores. Today, the industry is nearly 40 lakh crores or probably slightly north of 40 lakh crores. In that, you have about 20-21 lakh crores in equity and the balanced in fixed income. So quick numbers will tell you industry is 5 to 6 times up. Within that, equity assets are 10 times up. Now let's look at the alternate space. 10 years back, alternate regulation was new. We had some VC funds and some RE funds, but the point is broadly the AIF regulations were new, right? And the industry was practically, say, close to zero or a negligible number. AIFs are now practically from zero, they've gone to well over 5 lakh crores. If you just look at equity, Cat 3, what we call, long short, long only equity funds, that's gone from zero to nearly 1.5 lakh crores. So the data tells you that while equity mutual funds, because they're retail products, or debt funds, because they're retail products, they get a lot of coverage. But the fact is that the alternate industry has grown a lot more. The adoption is rising. It's growing faster than the mainstream mutual fund industry, actually.
All right. Saurabh, your thoughts on this? The fact that attention is not being paid as much to the growth that alternative investments have seen here.
This industry has been relatively new. And more importantly, what's also happened is that the alternative products, just to give you an example of AIFs, because of this nature of the structures itself, they can allow you to do certain things that traditional products do not. Just to give you an example, if you have to, let's say, go for absolute return strategy, or if you have to manage volatility, there are products in AIF, in Cat 3, for example, that allow you to do a long short product. Or let's say, for example, if you want to build a portfolio for a period of time, then of course there is a Cat 3 long only AIF that you can build as well. But then there are other categories in AIFs, Cat 1 and Cat 2, where if you want to take exposure to wider asset classes, unlisted equity, you want to take real estate, you want to take other kind of, renewable investing and so many other asset classes. Those are asset classes that AIFs can also give you, and alternative products can give you exposure to. And that's why the prominence and that's why the growth. And we believe that for affluent investors, this is definitely going to be an asset class that they will look for.
All right. I also want to take the conversation in the direction of understanding the role that regulators have played in sort of cultivating this ecosystem for a lot of the wealthy investors. So, Sujintan, maybe we'll get your viewpoint on this and how you rate the regulators on how they manage this ecosystem.
No, regulations are all pervasive, and a lot of the changes we're talking about in the industry are being aided by regulations, right? Ashish spoke about international diversification. It has come on back of regulatory relaxations, right? So that we need to acknowledge, and before we discuss about the themes. 2 or 3 things I want to call out here. See, one thing is the regulators across the board have been extremely friendly to innovation, right? So whether it is talking about taking a sandbox approach, encouraging changes in a controlled manner of doing things differently as compared to what was done before, right? So that's something you're seeing SEBI or RBI or even other regulators also actively encourage, right? And that is having its rub-off effect on the business models of wealth managers. The second thing is the regulators have also been very clear and consistent about the guidance on certain emerging asset classes, right? What are the associated risks, making sure that
proactive.
Making sure that the customers are well aware of the risks they're getting into and not getting dazzled by the returns, right? So there a very active role has been played by the regulators. And thirdly, the regulators have also played a very active role in fostering an ecosystem across regulations, right? If you look at the recent SEBI move of joining the account aggregator framework, that's going to give a big fillip to account aggregator as an ecosystem itself, right? And that will hugely simplify the onboarding journey when it comes to wealth management firms. So a lot of changes in the making.
Absolutely. And speaking of the account aggregator framework, I guess you could say for regulators, the role has become more proactive than reactive, right, Saurabh?
Yeah, absolutely. Clearly, we believe that, I was reading a note recently by Prashant Jain, who was a much admired fund manager after a long career when he left HDFC. And one of the things he has given credit to for the kind of performance of our industry has been the vastly improved regulatory framework. Specifically when it came to account aggregation and giving a portfolio view to an investor, that's something that we've seen is an strongly emerging need that clients have. So there has already been a lot of steps that the industry has taken. And just to give you a sense on that, one is that there are portfolio statements like ECAS that RTAs provide, or NSDL and CDSL also provide a consolidated view at an investor level across various distributors or providers or manufacturers you may have, which gives you both MF and DMAT holdings in one place. Account aggregator is going to be a game changer for the industry because SEBI, as Suchintan pointed out, has very recently decided to join that framework. When we have that, the clients will be able to see their entire portfolio across financial assets, whether it's bank accounts, FDs, DMAT, mutual funds, bonds, hopefully insurance in some time, in a single place. And that's something that we believe, again, at Standard Chartered, our entire approach is Wealth 360, where we want to give, and every investor wants a 360-degree view of their entire holdings in a single place.
Absolutely. They all want a single dashboard view for all their sources of wealth. But then how do you move forward in terms of your value proposition to clients? Now, that's we've taken care of, let's say, the information. Now, in terms of the value proposition, how are things going to move forward?
So the way it's going to move, Gautam, is the first thing is that if an investor, if someone like you or me can see our entire financial holdings in a single place, ability to track and see itself is far superior. Thereafter comes the overlay where I can actually give advice. I can do a review of the portfolio and I can look at the products that the client has and see whether there are any recommendations. Both the client and the wealth manager can have a far richer conversation. That leads to superior decisions on asset allocation, product selection, and managing risk and volatility over a period of time.
So, Chintan, the emergence of the millennials, you can't go away from that in any discussion. And they understand the innovation ecosystem much better. So I want to understand from you, what are the use cases emerging in terms of, say, wealth firms leveraging big data and analytics to improve their client acquisition when they target millennials, or servicing, or a whole lot of other dynamics at play? What are your thoughts on this?
Wealth management will remain a phygital model, right? That's our belief, right? However you digitize it, there is a human touch that is required, especially in certain segments. Therefore, there are use cases which are also emerging. How do you enable the front line in having the right conversation with the customer? Let's take the example of any market event, right? What does it mean in the portfolio of your client? Now, a lot of cases, historically, this had been left to the individual to interpret and then take a particular offering or a solution to the client. Now, a lot of that can be prompted by machines and algorithms today, right? So that's something which we are seeing. And therefore, how do you nudge and make the conversation richer in terms of the data and make the frontline helpful towards that? The second point is, of course, a lot around the process automation around the back office, right? I mean, often it gets less spoken about. There we are seeing emergence of, say, whether robotic process automation or other tools, which then frees up the bandwidth. Now, what wealth managers also need to think about is, what do you do with that additional bandwidth? How do you reskill the front line, or how do you deploy certain talents in other areas? Those are becoming emerging questions. Now, one thing to think of, irrespective of the use case, is one, the idea is not to get dazzled by the technology itself. What's the business case to start with it? I'll give you an example. We worked with one of the wealth managers where deploying RPA in certain processes led to freeing up of 2 million minutes, right? And we measured that. But these were across various departments. And the value of every minute is different across every department of the wealth manager, right? So how do you prioritize? How do you start with a measurement first approach and then get into technology? That is something to think about.
Saurabh, as we wrap things up, technology has gone from the back office to the front office, especially for wealth management firms. So your last word on wealth management of the future, what are you looking forward to?
I really like the way Suchintan made that point that it's going to be a combination of physical and digital. I think the future looks promising and bright. But the future also has a very strong overlay of a very, very robust macroeconomic and regulatory framework within the country, and the access to these products, and the ability to present everything to a client in a single place, and the ability to then add value both digitally and physically through a discussion between the wealth manager and the client. So that's the broad view that we have, on the future of wealth management.
Absolutely. And looking forward to a robust wealth ecosystem for both investors and, of course, wealth managers as well. On that note, it's time to wrap up our talk around reshaping strategies for wealth management in the post-pandemic economy as part of the 6th season of Standard Chartered and CNBC-TV18 present India on the Move. I'd like to thank all of our panelists for sharing with us their insights of the topic, and of course to our viewers for tuning in. Till next time, this is your host Gautam Srinivasan signing off. Have a great day.
Standard Chartered and CNBC-TV18 present India on the Move, Season 6.